You're listening to Peter Lewis's Money Talk.
Good morning, this is Peter Lewis. A warm welcome to my podcast Money Talk for Thursday the 30th of March. Each weekday morning we discuss the top business and finance stories with some of Asia's top fund managers, economists and analysts. In the headlines today, shares of Alibaba soared over 12% in Hong Kong after the company announced a radical breakup with plans to split into 6 business units. Other Chinese technology groups rallied, with traders interpreting the news as a signal that Beijing's crackdown on the tech sector is nearing an end. Taiwan's President Tsai Ing-wen has begun a 10-day trip to Latin America with stops in New York City yesterday and Los Angeles later in the week. Whilst in California, she will meet House Speaker Kevin McCarthy, and China has threatened it will respond if the meeting goes ahead, saying it will be another provocation that severely violates the One China principle. Tesla founder Elon Musk and a range of experts called on Wednesday for a pause in the development of powerful artificial intelligence systems to allow time to halt what they called a dangerous arms race. In an open letter, which was signed by more than 1,000 people so far, including Mr. Musk and Apple co-founder Steve Wozniak, was prompted by the release of GPT-4 from San Francisco firm OpenAI. The letter stated recent months have seen AI labs locked in an out-of-control race to develop and deploy ever more powerful digital minds that no one, not even their creators, can understand, predict or reliably control. Hong Kong home prices reached a 4-month high last month. Secondary home prices in Hong Kong rose 2.2% month on month after an increase of 1.1% in January. However, when compared with a year ago, prices were down by 9.8%. On today's programme, my guest will be Andrew Freris, the CEO of Ecognosis Advisory, and Chris Lee, Senior Partner at Farron, Augustine and Alexander Investments. With a view from South Korea is Peter Kim, Managing Director and Investment Strategist at KB Securities. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com. On Wall Street overnight, risk appetites continue to recover from turmoil in the banking sector, sending US stocks higher, ahead of important inflation data on Friday, and also calmer treasury markets helped stocks. The S&P 500 powered back above 4,000 with all 11 sectors ending in positive territory. The S&P 500 gained 1.4% to end at 4,028, leaving it with gains of 4.9% for the quarter and year to date, despite the collapse of 3 banks during that period. The Dow surged 323 points or 1% to close at 32,718. Strong gains in the technology sector helped the Nasdaq rebound after a losing session. The Nasdaq Composite added 1.8% to close at 11,926. And it's seen gains of almost 14% over the past 3 months as the quarter draws to a close. The Nasdaq 100, which is dominated by mega-cap tech stocks, entered a bull market, rising 20% from its December low and on track for its best quarter since 2020. The main indices in Hong Kong jumped higher, led by Alibaba, which ended the day over 12% higher following the announcement of its reorganisation and adding more than $30 billion to its market value. The Hang Seng was 408 points, or 2.1% stronger at 20,192. The tech index soared 2.5%, taking it to the highest level since last February. Other Chinese technology groups rallied, with traders interpreting the news from Alibaba as a sign that Beijing's crackdown on the tech sector was near an end. Shares of Tencent rose 1.8%, Meituan gained 4%, Baidu climbed 1.9% and Guizhou jumped 1.5% in Hong Kong, as investors focused on other technology groups where there was the possibility of a similar restructuring to unlock shareholder value. Elsewhere in the markets, the bond market sell-off lost momentum. The yield on the 10-year Treasury yield was down 1 basis point at 3.57%. And you can get more details on the latest market movements on my daily blog at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk.
Let's join our guests. We have with us this Thursday morning Andrew Freris, the CEO of Ecognosis Advisory. Morning, Andrew.
Good morning.
And also with us is Christopher Lee, who's Senior Partner at Farron, Augustine and Alexander Investments. Morning, Chris.
Good morning, Peter. Good morning, Andrew.
Now, shares of Alibaba, as you heard there, up over 12% in Hong Kong, adding a staggering $34 billion in market value after the company announced this radical breakup. It's going to split into 6 business units. The restructuring was announced just a day after the company's founder, Jack Ma, returned to China after an absence of 3 years to help restore confidence in the private business sector. And his presence in China, after spending several months abroad, strongly suggests that he was involved in the Alibaba restructuring. So, Andrew, investors, shareholders getting very excited about this, not just for Alibaba, but also other technology groups as well, believing this is going to unlock shareholder value. What do you think? Do you think it will? Is it a good idea?
Well, first, it is utterly predictable because when the initial attempt, I would say that again, attack on Alibaba, I think it was nearly 2.5 years ago, took place, the emphasis was that it was too big and it should be broken up. So now it is broken up. Again, no surprise, except, of course, for the timing. The second point is, I'm afraid this is a little bit pedantic because we always talk about the tech sector. At the time that the Chinese authorities were having a go, the tech sector they were attacking was the application of software to particularly retail and financial services. The tech sector consists of a large number of very different companies, such as Intel, for example, that makes hardware, Microsoft, that is a combination of software and hardware, Apple, which is also a combination of software and hardware, and the thing goes on. So in other words, the Chinese did not attack their own companies that were making microchips, or like Huawei that was applying both physical components and software to specific applications. So if we say, hey, the tech sector is doing very well, I'll clear my throat and I'll say the tech sector in the sense of the companies that apply software to specific functions. Now, I'm afraid I don't have specific information to find out what's happening to chip-making companies in China following the breakup of the Alibaba. I know it is pedantic, but sorry, it is very important to define what is and what it is not. Otherwise, you will end up saying that, motor cars are now more than 30% composed. I'll try that again slowly. Composed of microchip and technological equipment. So, in a sense, the car industry is part of the tech sector. Well, it isn't. Come
on. Chris, I mean, it seems that potentially here we've got the right outcome. But maybe for all the wrong reasons, isn't it? I don't think Beijing did this because they wanted to unlock shareholder value. They did this because they want more control over their companies, and they really don't like these enormous conglomerates and feel they can control them better if they are broken up. Is that assessment correct, do you think, or how do you see it?
Well, I see this as a classical valuation arbitrage exercise, right? Not from the political point of view in Beijing's kind of like thinking process, but more from the private sector, capital market people type playbook. They always have this, theory, as we learn from school, that the sum of the parts, right, can be either greater or smaller than the parts combined. So what Alibaba is betting on is that when they announced this scheme, they are hoping that they can unlock the value. But I'm not so sure about that as of now, because it all depends on how the markets will react to this. Because different fund managers and also hedge fund guys will have different valuation on the 6 different components of Alibaba. So this is still, I think, uncertain whether they can actually unlock the value, because, it all depends on whether or not you believe in the theory of when companies merge together, they could actually create more efficiency and actually enhance profitability. But here we're seeing the opposite, that they're trying to break up. But I think they have no choice here, that they have to break up, whether or not it will create shareholder value or not, because the pressure is coming from Beijing that they must break it up, just like what happened in other sectors before, in the oil sector many, many years ago in the U.S. and also in other sectors. So we've seen this movie before.
I mean, what you're talking about here is what's known as the conglomerate discounts, aren't you? Where a company, a very large conglomerates like Alibaba, it tends to trade at a discount to the sum of all its component parts. But breaking it up to unlock that value, history isn't really on Alibaba's side, is it? Because JD.com has sort of done that already. And if anything, its conglomerate discount has just widened since it sort of spun off some of its subsidiaries.
Exactly. That's my point, because the markets did not react well to that. And so I am, still a bit skeptic on this exercise. But I think, again, to your point, I mean, the process is already in place. They are going to, restructure, and I wish them well on the restructuring.
Well, it'll be, Andrew, this is an interesting experiment, isn't it, to see if this works.
And Peter, to be also very politically correct, it isn't just the Chinese authorities that got either politically upset or economically upset or a combination of both on tech mega companies. Let's not forget the repeated attacks by the European regulatory authorities on Google, ditto, of course, with Meta, or the old Facebook in United States. Just to mention too, that the authorities to be have repeatedly said you should break up because too much is too much. And of course, as Christopher indicated, they were not hypocritical enough to say this is going to generate additional value for the shareholders. It simply is going to break up a company which is too big for its own boots.
Chris, do you think this is maybe a model now for other tech firms like Tencent, like Baidu, or are they so different? I mean, Tencent, just too different to Alibaba for this to be able to work. But I do wonder if, particularly maybe governments in other parts of the world as well, might be looking at this as a model for how they deal with some of their large tech companies that they feel have just got too big, too dominant, and too powerful.
I do think this is a model for better management because as companies become so big that one CEO is, I think, too much. It's just become too much for one CEO to manage such a diverse group of business and companies. We've seen that in the telecom sector. We've seen that in also the banking sector, and we've seen that in the oil sector as well. So I think, it's limited by just human capacity, right? One cannot be doing too many things at the same time. So I do think it is a good thing to do. Whether or not it will actually generate shareholder values, I think depends on whether the individual 6 CEOs can actually do well and also, maintain the market positions in their respective sectors.
And it was also what was interesting in the statement. These 6 businesses can go and IPO as well if they want, which I assume will get the Hong Kong Exchange very excited. But the one thing that was missing from the press release, not a word about Ant Group, which really, the cancellation of that IPO really kicked all of this off, didn't it? But do you think maybe that's now back on track?
I do think so. So it opens the sort of like a door for Ant to come back. And Ant itself, as you know, is also, a combination of 6 or 7 different verticals of businesses, right? They have their insurance arm, they have their brokerage, they obviously have their e-commerce, and they have all the other verticals, including cloud and other pieces. So I think it is a good way forward, and at least, you look at the regulatory side. We have an agency for regulating the insurance companies. We have an agency regulating the banks and the brokerage industry, and also the MPF asset management component. So they are, I think, doing what is expected by the government. So again, I think that is a positive development for Ant Financial going forward.
Andrew, if we look at the markets overall this quarter, as we come to an end now of the first quarter, It's been pretty good for technology stocks, hasn't it? Taking your point that, of course, there are many different types of technology stocks, but the NASDAQ 100, which is really those big mega caps like Amazon and Alphabet and Microsoft, back in a bull market now. It seems that people are falling back in love with technology.
Yes, and here is where I will take a microscope, and I'm sorry, my needle is stuck, and I will talk about technologies, but I will try to say something in the context of defense companies, because the sector that has done spectacularly well in comparison to S&P, not saying in absolute terms, but simply in relative terms, have been practically all the major and minor defense companies in the world. And remember, these are voracious consumers of technology, both in terms of physical technology and in terms of software technology. So if one was to be really picky, I would like to have a combination of something which is technological and at the same time sells guns. I'm sorry, I'm being incredibly blunt here. Right, and the reason for that has been a huge surge of defense spending literally across the world, starting with the war in Ukraine. It has been quietly going on. There are continuous news, if one picks them out, of more and more money being spent on a group of companies that are very close to technology, and also, and this is very close to my heart, they are companies that are almost very inelastic vis-a-vis increases in interest rates, because their customers are very inelastic in terms of increases in interest rates, because their customers are overwhelmingly governments. Nice to have it.
And Christopher, if we look at the market performance this quarter, and in particular, you look at the broad indices, they've done not too badly, have they? You wouldn't have believed that there's been in that period a banking crisis, but are you a believer in this return to technology?
I am, and so I think there are still, momentum that is supporting this bullish market. And so as we know, Hong Kong has the campaign of Hello Hong Kong, and China is also now very focused on really fulfilling the promise of economic growth of 4 or 5%. And now that COVID is behind us, I think people's expectation is we're going to get back to making money and also producing gains and profits, and hopefully it will drive the economy. And so I do feel optimistic about what's happening in the marketplace. There's a little bit of hiccups, of course, the SVB situation and also the failures of several financial institutions and banks, but that is expected. But overall, I think the policymakers are being pragmatic about this, even though it was a little bit slow for us and China in Hong Kong and other places to kind of remove all the restrictions. But now that we can all travel freely to everywhere, so I do think that tomorrow will be better, and then hopefully the rest of the year will be better for us too.
Do you think the banking crisis, if crisis is the right word for it, has now been contained? We're seeing the volatility in the bond markets, which has sort of almost moved in correlation with that crisis. The bond market volatility seems to have calmed down a bit in the last couple of days or so. Should we be taking that a sign that maybe the worst is over and the regulators and government officials, the US Treasury, have done a good job in getting things under control?
I think there is a very interesting theory out there that I could share with both you and Andrew here. So we looked at, how this, had happened, right? And some people actually describe this as a self-inflicted problem in the United States, because I remember a year ago when I came on the show and I talked about the tariffs on products imposed by the U.S. government are too high. And because ultimately, who's paying for the higher prices? The average person on the street. So because the tariffs are high, and therefore you have inflation, and the Fed has been printing a lot of money, so that added to more inflation. And because they needed to fight inflation, so what did they do? They had to hike rates very, very aggressively, 475 basis points in 1 year. And as a result, higher inflation, higher interest rate led to bond prices decline very rapidly, and it led to the failure of several banks. So this can all be actually prevented if they did not put on such a high tariff rate. And so I think that, if people were advising the government officials now, they would advise them to seriously consider reducing the tariffs and also help, reduce inflation and also keep rates under control and provide more stability and lower prices to the average person in the U.S.
It's interesting what you say there, Chris, because I put that question to my guests earlier this week, that in many ways this is a Fed crisis. It's been caused by the Fed raising interest rates, 500 basis points in just over a year. But I think my guests rather thought that was unfair on the Fed. But it sounds like you rather agree with that ultimately the Fed is the root cause of this.
Well,
yes, and also, and I would add one other point in terms of just the stress testing that the regulators and Fed had done was biased on the rate reduction side. They had done stress tests on how banks or the system would react if rates were cut aggressively. But I don't think they did a really nice scenario and stress testing and scenario analysis on how banks could potentially fail if rates were going up too aggressively, too fast.
Peter, let's get a couple of things straight. Blaming the Fed for the demise of Credit Suisse is completely irrelevant. Credit Suisse collapsed slowly over a 10-year period through mismanagement, scandals, and poor overall leadership. It has nothing to do with increases in interest rates. It didn't help. Okay, it was the SVB, the Silicon Valley Bank that had the problems by taking what not to do in managing a bank portfolio and ticking all the box. Okay, in other words, it was absolutely undiversified in its assets and paid the price. And also, of course, the depositors are poor soul. The depositors, we have to protect them. All of them were massively into non-insured deposits. So you get to pay the price. Actually, in the case of SVB, you don't get to pay the price because the government rescued them.
Andrew, you remind me of a quote. I can't remember who said it. It might have been Oscar Wilde, who asked someone, "How did you go bankrupt?" And he said, "Well, slowly at first, but then very quickly." This seems to be exactly what's happened to Credit Suisse, doesn't it, over a long period of time, but then accelerated at the end.
And also, I just put out a piece which is a little bit boring and repetitive, and it starts by a quip by Voltaire that said the Holy Roman Empire was neither holy nor Roman nor an empire, and I would say the banking crisis was neither a banking nor a crisis. Hang on, it was a crisis for three banks. Come on, three banks. Okay, there were the two American banks plus SEV and Credit Suisse. Nobody else had a problem. So why do you call it a banking crisis? Also, the Americanization of everything that happens. The Americans have got problems with their banks. This is a global banking crisis. No bank in Asia had the slightest problem. No central bank in Asia had to take extraordinary measures. Actually, for that matter, no banks in Latin America, ditto, had to do the same thing. And even the European Central Bank, it said, all right, there's plenty of liquidity available if you want it. So, as you say, it was the Fed. So we are all, Sam Goldwyn said, please include me out. Okay.
I think Andrew has a very good point on the Credit Suisse situation. I mean, I do agree with you that the mismanagement there is, again, shown in the 2014 event that I think, they were accused by also the authorities for helping Americans to reduce or evade taxes. So that was, I think, something that definitely I would agree with you on that one, Andrew. But I think my point earlier was that domestically in the U.S., I think for the local banks and the regional players like Silicon Valley Bank, it failed partly and largely because of the high tariffs and the high inflation and the high interest rates and the speed at which these go up that led to the demise of Silicon Valley Bank. I think that part, I do feel that the Fed is responsible for that. But for the Credit Suisse one, I do agree with you that it was not related to the Fed.
And also, actually, Christopher, I will beg to differ. It takes two to tango. For the SVB Bank, okay, you had two components. You had the corporate components, all of which held massively, less than about 6% of the deposits of SCB were insurable. In other words, 94% of all the deposits were above the $250,000. Well, if I do that, I know I'm not going to be insured. So why on earth should I possibly claim that this is something which is systemic, which is whatever you want to call it? So, the blaming increases in interest rates on this particular choice by depositors is almost irrelevant. Okay, these guys were there because the bank was giving them a lot of loans. It's perfectly all right. And then this is an undiversified portfolio. And you know what happens with undiversified portfolio? You pay the price.
Yeah, the speed at which the deposits left, SVB was just absolutely historic, right? I think they have a total of $175 billion in deposits, and over a short period of time, $140 billion left. So, I mean, no banks can actually survive that type of bank run in such a short period of time.
I mean, we're in this type of fractional reserve banking system that we run around the world. It is a big confidence trick, isn't it? It does depend upon confidence remaining with those banks, because no bank can return all your assets all at once, all your deposits all at once.
Also, Peter, may I get off my chest another of my really pet hates, because this is so stupidly expressed. Deposits left the banking system. No, they didn't. They went from one bank to another. For deposits to leave the banking system, on a net basis, all the banking system has to reduce its loans. This is really basic 101 double-entry bookkeeping. The overwhelming liabilities of banks are deposits. The overwhelming assets of the banks are loans. Loans to the public sector and loans to the private sector. Hello?
But isn't that a perfect... It's a perfectly rational behaviour, isn't it? Because if you have your deposits in a bank where you're earning 1% and money market funds are giving you 4%, it's perfectly rational, isn't it, to take your deposits out of that and put them into money market funds, which is what's been going on.
Peter, hello, sorry, don't make the same mistake. If I take my money out of a bank, then I simply remit it to another bank.
No, Andrew, I understand that. That's not what I'm saying.
So nothing leaves anything.
No, I didn't say it leaves the banking system. What I said is it goes into a money market fund, which is a perfectly rational response to where interest rates are. You get 4% in money market funds, so it's not really a surprise, is it?
No, that's not my peeve hate. My peeve hate is reading continuously in the press that deposits left the banking system. No, they didn't.
Well, that's not what I said, though. I agree with you. That's not what I said, that, the deposits are still there. They haven't disappeared into thin air. They're just in a different part of the banking system. But my point is, and Chris, maybe you can have the final word. It does seem rational, doesn't it, that people will consider, where if you've got a money market fund that earns 4%, you get under 1% in your bank. It shouldn't be a surprise, should it?
Reallocate. That's right. Yeah, Peter's word is what I would use too. I mean, they reallocated from one firm like SVB to another firm or to another instrument. And so we saw in the news that B of A, Bank of America, received like $15 billion of deposits from SVB within a few hours on Thursday of that week. So I think I agree with you that, Andrew, it's not true to say they left the system. They just went from the left pocket to the right pocket.
Thank you.
Andrew, final word to you. You've done a report called Crisis, What Crisis? One paragraph in that caught my attention says panic actions can't be forbidden, punished or controlled by reasoning and targeted action. People have and always will act on beliefs and not facts. And you say the current banking crisis contains nothing new, both in terms of causes and in terms of policy recommendations. So it sounds like people are just going to repeat this same mistake over and over again, and we're regularly going to get this type of crisis. Absolutely. And actually, the Congressional Committee in the United States, right now, as we talk, had a fabulous conclusion that whichever we do, we will end up, let's say, upset. I don't want to use the word that starts with an S. Yeah, absolutely. I mean, this is zero novelty in what I say. Okay. We had 2008. We had 2008, and clearly we learned nothing from 2008. Not because I'm intelligent enough to learn things. It's because that's the way people behave. You can't change that. Okay, well, great discussion. Thank you very much for your thoughts there. That's Andrew Freris, who is the CEO of Ecognosis Advisory, and Christopher Lee, Senior Partner at Farron, Augustine and Alexander Investments.
You're listening to Peter Lewis's Money Talk.
I'm joined now by Peter Kim, who is Managing Director and Investment Strategist at KB Securities over in Seoul, South Korea. Good morning to you, Peter.
Good morning. Welcome back.
Thank you very much. So we're ending the first quarter of the year. If you look at stock markets around the world and look at the broad indices, you would have almost thought nothing's happened. The broad indices have done quite well, but my goodness, what it's masked underneath, particularly in terms of banking stocks. I'm interested to get your thoughts first of all on the banking crisis. Is that the right word to use? Is it a crisis?
In the old days, it definitely would have been a crisis of some sort that would have left a lasting mark and possibly even skirted with the dangers of a contagion. But I think we are living in a different times now for two reasons. Number one is that the governments are so ready to step in to avert anything that resembles the previous Lehman crisis. And we've seen that with the three potential bombs in consecutive days, actually. And that was very impressive. And I guess the second thing is that we have a lot of uncertainty outside of the monetary policy that informs the geopolitical risk in terms of the deglobalization. And all of that, I think, has put everyone on alert. So in a way, we've probably benefited from the heightened sense of urgency all around the world since COVID. And I think that is one of the reasons for the readiness of the government stepping in to avert a contagion.
Was the government right to do that, though, after the global financial crisis? We were always told that this wouldn't happen again, that governments wouldn't step in. And here we are. They've extended already in the US the deposit insurance. It covered 100% of the deposits at Silicon Valley Bank and Signature Bank. Are governments right to do that, or does it just make it more likely that we're going to have another crisis because it increases the moral hazard? Yeah,
it does resemble a lot of what we saw from Japan from about 20, 30 years ago, to be honest. If you remember what happened with Japan is that they actually never had a crisis. But with a ballooning of government debt, with the numbing down of the financial sector, they've gone through, what they call now lost decades. And I think the developed economies in particular are in danger of falling into that trap. As far as having the right to do something like this or not, I now distinguish between policymakers and politicians. And I think it's a very important distinction because politicians live for the day. Mm-hmm. Policymakers have the mandate to try to model something that's a little more sustainable over the longer term. And I think what we're seeing now is definitely the ascendancy of politicians over the policymakers.
Do you give the policymakers good marks for the way they've stepped in and handled this?
I think policymakers right now are in rugby terms, are the fullback just trying to avert that try being scored, if you're a rugby person, rather than the ones who go forward trying to win points. Yeah. So policymakers on the defense, politicians are attacking.
What about in Asia? You mentioned Japan. It's interesting, isn't it? Because Japanese banks, if you look around the world, who is it that holds the largest portion of US Treasury bonds? Well, it's Japan, and a lot of them are stuffed either into the central bank, the Bank of Japan, or into Japanese banks. They've got enormous holdings and enormous losses now as well, haven't they?
Yeah. Well, Japan is just a fascinating case and used to be for its own reasons. Now, how it resembles a lot of what we're observing in other parts of the world. In essence, what you see from Japan is that they actually basically own the domestic bond market. They increasingly bigger holders of equities through ETF holdings. And now I think they have significant influence over the FX market. Now, that sounds very much like China now, doesn't it? And probably likely to be so. And I think one of the reasons why there is no crisis from Japan is that the government basically bankrolls its financial markets. So there's no undesirable volatility and dislocation. And I think we are entering into a world of bigger governments having bigger balance sheets and using those balance sheets to avert a short-term crisis or maybe a recession. But the cost is, once again, declining long-term growth potential.
What about South Korea?
And that goes for China too, sorry.
What about South Korea? Are the banks there sufficiently different to what we're seeing in the US and Europe to sort of ring fence them, or do you have in say Germany and the US and Japan all these regional banks where maybe there are problems that we don't know about?
Yeah, I mean we've seen from Switzerland how vulnerable a small economy is. The bigger ones who run a pretty good trade account surplus, like China, like South Korea and Japan, can afford to, be a little more generous with the government support. And I think perhaps some of the weaker economies will have to face the music. But I think I'd like to think that South Korean central bank is different. But in a sense, they deal with the same problems. They are beholden to ensure that they're not the odd one out to have the first crisis. So I don't know whether I can say any central bank is different, but even the most frugal of central banks, Bundesbank, I mean, they're doing the same thing. They've given up on this very constrained government debt posture now. So if there is one thing that I would say that has structurally changed through COVID, I must say it's got to be the socialism spreading. And alongside that, ballooning of the government debt and government spending.
And what about the markets? I mean, overall, the major indices around the world have done not too badly. But if you look inside that, you've seen a real underperformance in the banking sector, a real outperformance in the technology sector. The Nasdaq Composite's up about 14% so far this year. Yeah. As we move into the second quarter, what's your thoughts and outlook going forward?
As much as we may perceive the markets to be holding forth on this FOMC stance that there is no rate cuts, I think the market behavior over the past couple of weeks shows us that we're still betting on the capitulation of the central banks by cutting should we start to see excessive slowdown in growth. I really think that's why I think the tech sector has rallied, even though macro fundamental has deteriorated. So I think that's one. And I guess second one is that the liquidity overall is still pretty good. Now, the biggest question is it good because there's a time lag? Or is it still that fact that despite higher interest rates, the government spending, fiscal spending is shoring up that the higher interest rate environment? I think that's probably the biggest question. I prefer the explanation that it's a combination of the lag effect and the fiscal spending. And if one of those starts to bear fruit, I think there is still some downside from this level.
And I presume that if the inflation data worsens, and we got in the US the PCE number, which is the Fed's preferred measure of inflation on Friday, if that picks up, then these market expectations of rate cuts could get upended very quickly. Exactly.
I think we are in a fairly tenuous position of expecting the inflation to remain on its downward trend. As well as no more dislocation in the financial system. That's probably the only way we can possibly see rate being stable or maybe even a cut. And I think that's probably at this point in the short term, too much to ask for.
Peter, thank you very much indeed. Always a pleasure to talk to you.
Thank you.
That's Peter Kim, who is Managing Director and Investment Strategist at KB Securities over in South Korea. And thank you very much for listening this morning. Just a reminder that you can find more information about some of the stories we've discussed today on today's programme, along with market updates at my website, peterlewismoneytalk.substack.com. We're almost at the end of the week. On Friday's programme, I'll be joined by Francis Lun, the CEO of Securities, and Andrew Sullivan, founder of Outset Global. With a view from Australia is Toby Lawson, director at Statin Advice. See you tomorrow.
Money Talk